Okay, good morning. How are we all? Still feels a little bit bizarre with the COVID-safe setup, but thank you for joining us at this Mergers and Acquisitions Skill Day. We're going to cover an awful lot of stuff at a high level, and it's going to be the beauty of a room just this size is we're going to get stuck in with a lot of questions. I've said it before, but I'll say it again, that what we're going to learn in this day has made me more than any other business skill set that I've known. It's definitely made me many multiples of millions of pounds. But, Carl, there's an important caveat. It's also lost me many millions of pounds, and I've been sued for the many millions of pounds from my lack of understanding the detail of some of the things that we'll be discussing today. So it's a very broad area with high leverage, high upside, but it is not, Christian, without its risks. So really today is not, for clarity, not meant to be a substitute for adequate legal accounting advice, etc., etc. It's really meant to be a catalyst, Tony, if you like, for generating some ideas, giving you some insights, and giving you some areas, Richard, in which to look where you haven't before. The day's roughly broken into three parts. Most of the morning will be the kind of the teaching element, and then as we go into the afternoon, it'll be in the Q&A side, and then the takeaway action plan. Inside that, there's a three-step process. When I've tried to distill all this down, I've broke it into three parts, which I think you're going to enjoy. We've also got a special guest speaker coming this afternoon. So a friend of mine, a co-investor, somebody that managed $750 million in a private equity fund in the city before he retired. A guy called Simon Inchley will be joining us this afternoon for your Q&A. So if you think that anything I cover this morning is good, not to put pressure on him, but what the hell, he's done it 10x. So this morning we'll be talking about deal sizes, probably of hundreds of thousands and low single-digit millions that I've done. I suspect this afternoon, if you ask Simon, he'll tell you about multiple deals that are tens of or hundreds of millions of pounds. So it's a tremendously exciting area. But we've got a handful of people on Zoom, and we've got people in the room. For the people in the, if you're on Zoom, type your answers this in the chat. But for the people in the room, it's probably worthy of quickly just having a run round, because we've got a few new faces since we've post-lockdown, pre-lockdown. There's a few new members for the group and a few guests that are here. So I think it's worthy of a quick run round the room. 10 seconds, please. Who you are, what your business does, and then if you want a bonus point, Tony, you can tell us what you'd like to get from today. And you get to go first, sir. And I've got to chase you around being a mic runner for the day as well.
Hi everyone, I'm Tony Thomas. I'm a financial planner, so my business is financial planning and wealth management. I'm from the other side of Cardiff, and today I'm going to open mine, but I'm looking for lots of good tips.
Okay, good stuff. Thank you, Tony. Emma.
So Emma Cartmel, we organise trade shows, exhibitions for the hospitality industry, and today it's really about how to move forward with things if you've got the opportunities, how to spot them and move forward.
Brill. Thank you, Emma. Lisa.
Hi, my name's Lisa, and this is my daughter Grace. Grace is another masterminder as well, just joined. We breed and train Australian cocker dogs for families internationally. Today I want to recap on the mergers and acquisition laws, forget the legal stuff, but also some practical tips. Obviously with the market hopefully going downwards, we're hoping to pick up a couple more premises.
Yeah, very good. Anything to add, Grace? No, you don't wish to? Okay, all right. Good. That's gone here. Christian?
My name is Christian Dodge and I'm from Leeds. I run a home automation business, so we do lighting design, lighting control, home cinema. From today, really, I'd like to investigate the pitfalls of acquisitions and the things to avoid, Dan.
Good. I've got plenty of those stories. Richard.
I'm Richard Cundiff. I'm a commercial landlord. I'm looking to sort of expand our commercial portfolio, and sort of with everything that's happened at the moment, with all the landlords getting hammered, hoping that there might be opportunities for mergers and acquisitions with smaller landlords and their companies up for sale.
Good. I like that. Ashley.
I'm Ashley Bullock. I've got an energy and technology business. We work with schools and businesses to reduce energy. I'm here. What I'd like to get at today really is I'm going through a business partnership exit, and also we've got an electrical element to the business which has sort of happened naturally, which we subcontract out. So that's always made sense to maybe acquire or merge with an electrical business at some point.
Very good. Thank you, Ashley.
Thank you.
Alex?
Hi, I'm Alex Kilcoyne. I've got an interiors business. We do made-to-measure curtains, blinds, wallpapers, paints, help people to make their houses beautiful. I actually bought the business a year ago on Thursday. Wow. So bought
Happy anniversary,
yeah.
maybe?
I actually bought a business that I didn't know anything technically about. So yes, I've had quite a steep learning curve. I did identify quite a few businesses when I was talking to them in the last, sort of probably 2 years ago. So there's some of them still I'm quite interested in adding to try and really grow the business, so I can have sort of all our sort of surveying, fitting and making up services, everything in-house really, and also some sort of management structure so the business can run itself.
Very good, very good. We're going to talk about that a lot today. Yes, sir.
I'm Simon Morris. I have a coffee business, an online fitness business and a sales and marketing business, and I'm here to really brush up on mergers and acquisitions.
Very good. Omar?
Hi everyone, my name's Omar McDaddy. I'm the founder, owner and director of Magnet Limited. We're an independent distributor of compatible network accessories. I'm here to learn more about mergers and acquisitions.
Very good. Mr. Stone?
Hi everyone, my name's Rob and I run a company called Instaloft. We do loft flooring, loft ladders, create storage space in people's homes, and I'm here really to look for my next opportunities, looking at home improvement companies, things we can add on or bolt on to our existing business, or even just invest in to help someone else do the same.
Good, we definitely got a home improvement vibe today, don't we? Yeah, very good. Steve?
Hi, I'm Steve Dennis. I own a gym fitness facility in Basingstoke. We've had it for about 8 years now, seems to be going rather well, so I'm looking for more tidbits and inspiration of how we can find other gyms or similar companies to buy.
And since you last saw CV's now also doubling up as Freddie Mercury, just double. So,
I was going to say something else.
Yeah. John?
Hello, John Taylor. I've got a gym as well, based in Norwich. I'm also a bit of a systems and marketing geek. I like all that sort of stuff. So I think there's probably going to be some gyms for sale in the next year or so, and also potentially other businesses which kind of need systems and marketing. So yeah, just I guess how to put deals together without exposing yourself to a ton of risk.
Good.
And losing everything.
It's a big chunk of today.
Morning guys, my name's Josh and I run a personal training studio. We help people lose weight and increase their energy levels. Yeah, similar to what John said about potential opportunities arising in the next 12 to 18 months because of what's going to be coming economically, and also from the session you did at Success Mastermind a couple of weeks ago about mergers and partnerships and things like that, and that's something that kind of piqued my interest, especially after the suggestion you made about looking for kind of freelancers or small businesses with clients and kind of merging them and bringing them into yours, and that kind of piqued my interest a little bit. So yeah, just developing my skills and learning.
Good, thanks Josh. Rob? Carl, sorry. Damn it, don't do that.
Morning, Carl Paul. Rob and I run a digital agency in Swindon. Our core focus is search engine optimization and lead generation on a pay-per-lead model. Both have a keen interest in mergers and acquisitions, looking to expand our knowledge and bring it into our strategy.
Good. Thanks, Carl.
I can copy and paste exactly what Carl said, but I'm obviously Rob from Smarter Media as well.
Good, thank you. So out of curiosity, and by the way, anybody that's on Zoom, feel free to chip in if you've got any specific comments or questions. I'll just have a quick look. Okay, technical problems, figuring out the sound. I assume guys at the back, you're looking at this chat feed. Yeah, so Rob Jones is online, co-founder of Property XYZ, building the world's most intelligent property platform. Help us see if M&A could be the right growth strategy. Okay, and Matt is there saying, I run a print and marketing product services business. Interested in learning about sourcing opportunities for acquisition. Greg says, my wife and I run one of many, a professional leadership development company for women, looking to learn from Dan to see the methods we can use to grow the business or generally acquire business or other opportunities. And hello to the other guys that are online as well. Very good. So, by show of hands, who here has bought or sold a company in the past? Okay, good. And so who has complete novice to mergers and acquisitions? Okay, great. So, majority is new, so we're going to cover a lot of things. Feel free to get stuck in with a lot of questions. Let me go to the slide deck. So, here's why you might want to pay attention today. Mergers and acquisitions are the fastest route to growth. Or they would be if my slides worked. It's the fastest route to growth. Whenever companies reach a certain size, it's very common that mergers and acquisitions will become part of their growth strategy. Why? Because it allows growing companies to become bigger more quickly. And if you think about it logically, there's a variety of reasons why that's true, which I'll demonstrate in a moment. So, this chap, who knows who this chap is on the screen? Yeah, go Carl. It's Jim Radcliffe, who 2 years ago was the richest man in the UK. He's now lolling around in fourth, I think. And his company, Ineos, is the largest privately held company in the UK. And its annual revenues are 63 billion for the last year that I could find the results for, which I think was 2019. 63 billion, and it's a privately held company. Do you know how many shareholders there are in Ineos? 3. There's 3 of them. And basically, how has he done it? It's all been through mergers and acquisitions. It's a great book. It's a well worthy a read. It's called, what's it called now? It's called The Alchemists. It's called The Alchemists, the Ineos story. And basically, it's about how they leveraged bank debt significantly to buy unwanted assets, cheap, and managed to fix them and grow them. Okay, and a lot of that type of stuff we're going to be talking about today, but in the context of small business, unless anybody wants to buy an oil refinery. However, despite this being a significant route to wealth, I think a lot of people that teach this stuff, there are some people out there that know what they're doing, and there are an awful lot of cowboys. But I feel generally, when it's taught, there's too much focus on the significant financial upside that there can be, and not enough on the significant pitfalls. This mergers and acquisitions can definitely make you extremely wealthy, but it can also screw you up and bankrupt you, as you'll hear from some of my stories today. I was never made bankrupt, but I could have been, and probably should have been, more than once. And that's despite me thinking I know what I was doing. And the more I get into this stuff, and I've been involved in buying and selling businesses for more than 10 years now, the more I get into it, the more I realize that I don't know. And I'm still learning, which is partly why today it wasn't put on with this intent, but it's a nice little byproduct. I said to Simon, who's speaking this afternoon, I said, truthfully, even if you don't all have questions for him, I'll quite happily just sit here and just pitch questions at him for an hour, okay? Because it's just such a broad area. So,
okay, let's do this. Today,
before I play the video, I'm a bit click happy. So this, I think, is one of the things that I think you guys get value, hopefully, from leveraging me for is I read a lot of material, consume a lot of material, so I've peppered a few videos throughout today that I've found over time that have been useful. And this is a really nice cartoon-based summary, 2 minutes, Emma, of mergers and acquisitions.
okay, let's do this. Today I'm going to teach you something about mergers and acquisitions. Products and services are things that larger companies can often build or provide more cheaply and more efficiently. In order to grow larger and gain the advantages of size, companies sometimes buy other companies. In this case, we talk about a merger or an acquisition. Mergers and acquisitions are often very large, important and costly projects that can change companies enormously. Because the whole acquisition process is very complex and involves many different areas, companies often bring in lots of advisors. When a new acquisition is being considered, one of the most important questions is, how much is the company worth? To establish the value of a company, you can compare the company to other similar companies, or you can estimate the profits the company will make in the future. Companies usually buy other companies in order to achieve cost savings or generate additional income. So it is also important for companies to estimate the future benefits. But putting a value on future benefits is not easy. Once the purchase has been completed, the companies may need to be reorganized and new responsibilities may need to be assigned.
Good. I thought it was quite a nice little summary. Any questions, thoughts, or what ideas, comments did that bring up, if any? Good, great participation, first thing. I like it, very nice. So let me try and illustrate it a different way. Let's get us on board with the concept as to why we're doing this. Because I think a big pitfall, Christian, that gets made, or I certainly made many times, and I have observed it many times, is when people learn how to do something, they think that they should. And just because you can buy a company and you can figure out clever ways to finance it and structure it, doesn't mean that you should. And people often lose sight as to what the actual purpose is. And the purpose is to, directly or indirectly, Tony, make money. And we're going to talk about ratios, we're going to talk about we're going to quite quickly get deeper into the nitty-gritty of examples. But at a high level, here's what it might look like. Let's say you had two businesses, business A, business B, each had 100,000 in annual profits. And each had a multiple of 3. So they were valued approximately at 3 times that annual profit. Therefore, they had a value of £300,000 each. Okay? If the owner of business A went and bought or merged with business C, what would you be looking for? In theory, somebody might go, well, on paper, you've just now got 200,000's worth of profit, and it's still a 3 times multiple. Therefore, it's worth £600,000, Alex. Okay? But clearly, that would logically not be a very good deal. It's all in the synergies, as that video just alluded to. It might look more like, hold on, because of cost savings, a combination, Josh, of cost savings and revenue synergies, so uplift, business A can sell its products to the customers of business B, vice versa, etc., etc., along with cost savings such as you don't need two accounts departments, you may not need 2 admin departments, you may not need 2 accountants. So there'll be cost savings. You might be able to consolidate into smaller office space. The profit may very well increase to 200,000 in each entity. So therefore, the total will be 400,000. But the fact that the company is bigger, and bigger can mean more stable, a larger company, Lisa, typically will sell for a higher multiple. Because it's got more, what's the word I'm looking for? More fail-safes. There's more kind of contingency pots. There's different revenue lines, different customer sets, different elements that can be leveraged. So this combined company won't equal 200 times a 3 times multiple, a 600,000 valuation, may look more like 400,000 times a 4 times multiple, which is a 1.6 million valuation. This would be an example of, and don't worry, Ashley, we're going to get into how to do this later. This would be an example of a great deal on paper, because you've created £1 million worth of value. The term for this, there's a term for this called accretion, which is a geeky mergers and acquisitions term, albeit I think it originally comes from physics, which is it's cumulative, it's generative, it net adds incremental value. So putting these two things together, the sum is literally greater than its parts. That is what this is about at a strategic level. It's about how do we create incremental value, or accretion, accretive value, okay? So, to tee us up, and I will come back for it as we go, I'd like you to tell me, I'm going to get a little list of every question, great or small, that you can think of. I'm dragging this out a little bit so you've got time to think of questions, so I don't go, do you have got any questions? And then nobody puts their hands up, and then I have to make up 10 questions on the spot. But any question that you can think of, big or small, I'm going to put a little list up on the flip charts at the front, Tony, and then that's going to allow me to make sure that I pepper it into the content. Because whilst I've got a structure for the day, Richard, I'm definitely want to make it as valuable to you, Rob, as possible. So you can talk about specific deals, or how do I do this, or Ashley, you mentioned about the you elegantly called it a business partner exit. I prefer to call it a business divorce. Okay, great. That might lead you to having questions about shareholders agreements, etc., etc. So I want to make a list now to make sure I try and cover it as best I can throughout the day. What questions do you have which I will make sure that we cover off throughout the day's content? Alex?
How to structure like your businesses that you're going to sort of buy.
Okay.
What I guess what you've already got really. So do you use a vehicle?
Okay. Yeah, so I'm just thinking about that. So I'm going to put deal structure, but underneath that. And by the way, on Zoom, make sure you chip in as well. We can't bring you on audio because we get feedback from the speakers on the room, but I will read your text. So deal structure. So inside of that, Alex, I'm going to put company organisation. Yeah. Okay, good. This pen's not very good though. John.
How to have the most amount of control with the least amount of risk.
Okay, good. All right. So maximum control. Minimum risk. Okay, good. What else? Tony?
Not taking on the liability of the dealership.
Good. Not taking on liability. Good. What else, Richard?
Can you buy through option agreements as if you
Good.
wanted to buy it straight away?
Okay. Actually, just put option agreements. I can answer that question now. The answer is yes, but we can talk more specifically about it later. Rob?
So raising the finance.
Yes, good. Great. Josh?
If I'm merging a business into my own, as we kind of discussed a couple of weeks ago, how would you value that? Because in my situation, it wouldn't necessarily be buying, let's say, another physical gym, which is an asset and a lease and staff and whatever. It would be taking somebody who hasn't got a place to train their clients and such and bringing them in. How would you value that when you're really just buying revenue as opposed to, buying it?
So I'm going to put two things down here, Josh. I'm going to put valuation, because if you're merging truly, then there's got to be, okay, well, I'm worth this, you're worth that, therefore our ratio is 60-40 or whatever. But I'm also going to put assets versus shares. So we're going to talk about like what you buy. That's just remind me about that point. Good. Any more for any more? John?
How to almost like get in and out at the same time, so like a flip.
Okay.
Sell before you bought or something.
Okay, flipping. Good. Let me just look on Zoom. Oh, this monitor's going all squirrely. Okay, can't see anything there. Yeah, it's flickering constantly. And yes, Christian.
We're trying to merge with a company at the moment. One of the challenges we've got is actually he's always got this huge receivables list of money's owed, so we can never quite get a date or a time to do it. It's just whether it just seems a big challenge.
Oh.
All those amount of money.
Good. I'm going to just put receivables down because I've got a few little tips on that one specifically that I want to dive in on, but I'm going to resist now. Accounts receivables. Yes, Alex? Was it?
Merge or acquire.
Okay, yeah, merge via acquire. See if it falls under one of the other categories. I don't think it does. Merge versus acquire. Okay, good. Any more?
Where would you find sellers typically, and how would you qualify?
Finding, yeah. So I'm going to just put sourcing down. Good. Okay, Greg, Rob, Matt, chip in if you've got any questions. Any more from the room? Yep, go ahead, Simon. Who? Perfect. I'm going to put that under the category of valuation. Yeah. Or because equally you can say, how do you even define profit? That's a heavily contested argument, often. Ashley?
It's slightly negative spin to the question, but when doesn't this work?
Good. That's a good question. Okay. I'm going to put when not to do it. Good. Oh, good. You're talking my language, Simon. So Simon said, what to look for. I'm going to label this financial due diligence. And I'm going to put the sub-notes, balance sheet and P&L. I've got half an example later that I can probably elaborate on to illustrate that point better. Alex?
So what you should do maybe once you've actually acquired it, so the first step really to...
Great. I'm going to call this the first 90 days. Yeah. First 90 days. Post-acquisition. Okay, good. Richard? So we're getting warmed up now, aren't we?
It might come under one of the other categories, but what about asset stripping? So you buy a company, but you only want, you're having to buy it all, but there's only a portion that you really want.
Yes. Yeah, okay. I will put it down as a separate one. Good. Any more?
I'm not sure this is a question.
Go ahead, Simon.
So should you expect people to do forecasts? So if we're buying a business, surely it's what it's going to do in the future that's important.
Yes.
Should we be expecting to see a forecast from the seller?
Yes. Good. I'm going to just label this seller forecasts. This is good. Oh, Emma. So, by the way, this is now a 7-day seminar.
No, it's about, it talks a lot about the team that you need around you. And you said at the beginning, this shouldn't substitute the legal. It's like who should be part of the acquisition team?
You can come again.
Coming anyway.
I'm just going to call that deal team. In fact, it's in the slides later as deal team, but just to make sure that we've covered that off. Good. Any more? Alex?
So we talked about cost savings on the previous slide. So what if there's no obvious cost savings, but there's other perceived benefits?
Okay.
Like how you would, I guess, forecast that sort of thing. Not quite sure how to put it.
Yeah, I'm thinking of the words. Can you give me an example of what that might be?
So if I'm, say, looking to buy another shop, I'm still going to have like another premises and a lot of overheads. But say one of the businesses has, say, got its own workroom and seamstress team that actually could be a benefit to have that all in-house, so that you've got more control over it, you've got the right culture of people all working, not using subcontractors and so on.
So is this about evaluating the benefits, or?
Yeah, I guess so, yeah. But not necessarily all being like cost savings. It's like fluffier stuff.
Yeah, it's almost like it's almost valuing intangibles, isn't it?
Yeah.
Indirect values.
Say again, Tony?
Indirect.
Yeah, indirect / intangible. How do you spell intangible? I'm not sure that's right. Valuation. I'm going to label that. I can kind of remember what that is-ish. Any more? Should we pick on the people that haven't given us any suggestions yet? What are you thinking, Steve? Omar?
I was just thinking of lead source, but you've already got that.
Lead source, okay, got it. Omar, anything to add? Ooh, that's a great one. I'm going to put a slightly broader category down, but I'm going to put who will buy. and I'm definitely going to talk about management buyouts, or MBOs. Okay, good. So there's a good list there, right? And then I'm sure we can pick up any more as we go. Okay, right, we're good, I think. So, just before we move into the kind of the 3 steps, or the 3 stages I see it, important point to consider is this. Today is, you could say today is about 2 things. It's about bolt-on acquisitions, i.e. how do you acquire companies that are going to create value, incremental value, John, to your existing enterprise. On the flip side of that, we're also saying, well, how do you prepare your company for exit? And it's really flip side of the same coin. So when we talk about the 3 stages now, this morning, it's more going to be geared from the point of view, Tony, as to acquiring. But we'll come back later, but I'll also chip in throughout. The 3 steps apply directly to when you're preparing your company for exit. Okay? Because I know most of you in this room have told me privately in Mastermind, etc., that you're looking to acquire companies. But I also know some of you have declared that you wish to exit. Some are in the near term, some are in the just sometime in the distant future, but you want to prepare to maximize your value. As Simon will tell you this afternoon, if you're going to really create intrinsic value, so we're not talking about papering something up. You know, you've got a company and you can tart it up a little bit. It's a bit like, what do they call it with houses when they prepare a house for sale? There's a name for it. Is it staging? When they'll, you know, they'll clean it all and they'll put the light in and they'll put bread in the oven and all that's designed just to kind of make it just a little bit cosmetically nicer to get a slight bump in the sales price. That's not what fundamentally drives intrinsic value. And the same when it comes to exiting your company. Are there little things you can do that give you a little bump, Christian, an extra price? Of course. But really to drive significant value, the difference between a kind of a 400,000 or 300,000 or 1.6 million exit price, you normally got to be thinking 1, 2, 3 years upstream. Yeah, if you don't want to be tied into this business and get a dirt cheap valuation. So we're going to talk about the bolt-on acquisitions and also preparing your company for exit, but most of the examples are geared, Tony, around bolt-on acquisitions. So there's 3 stages, and those of you that know me well know that I'm a fan of alliterations, so you can try and figure out the next 2 as we go. The first one we're only going to touch on lightly now because it's actually the most difficult, so we're going to touch on it at a high level and then we're going to loop back round to it later this afternoon once we've covered the fundamentals. And the first step, deal flow. Deal flow. So the 3 steps are high strategic points, and then there's lots of tactics inside of that, Rob, which is how do you do it. So if you want to get a good deal on a company, the best thing you can do is look at a whole variety of companies. Deal flow is true if it is company acquisition. It's also true with property. It's also true with employees. If you take a new employees onto your team, if you want to make a good hire, there's a lot of things you can do in the interview process. But if you've only got 3 people, Carl, coming to your interview, right, your chance of getting a good candidate shrink exponentially. So in illustrated form, it looks something like this. Right, so this is from, I probably should have put the website on there, but I can't remember which one it was. This is from some mergers and acquisitions website as an example of deal flow. It's like scanning 650 deals, slightly more diligently reviewing 350, examining 30, 15 there are offers put to, letters of intent, and don't worry, we'll get into Grace what that means. 4 to 7 going through proper due diligence, and 3 to 5 deals closed. But for every 3 to 5 companies bought, 645 were rejected. Okay? And I suspect the ratios vary. If you ask Simon for his equivalent of this later, he'll probably be able to tell you what his private equity firm, Gresham LLP, did. But my experience, just as a kind of a solo person doing it, may not be that high, but it's not a million miles out. you kiss a lot of frogs. You know, I've got a small private equity in this group myself. One person in this room is an investor in that group, knows that, you know, in the last year, much to their frustration, we've only made one investment, but we've looked at a lot. You've got to kiss a lot of frogs. So this is why this is the hardest piece of the game. It's like, how do you find companies to buy? Okay? But there is good news, Simon. A blessing at the moment. It's called the greatest recession, depending on how you judge it, Josh, in record, means that there's an awful lot of companies right now that are in dire straits. So there's awful lot of companies or assets that can be bought very cheaply. So John, I think it was John who said it, and maybe I have to say, no, there might be some gyms for sale. I'm like, there's a plethora of gyms for sale. There's a chunk of gyms for sale within a 5-mile radius of where we're sat now. I know a few of them have come across my desk, but the question is, how do you filter them? Okay, how do you filter them and get into it? So I'm going to give a couple of tips, and then I'm actually going to throw it out to a simple exercise for you guys to do. If you buy this concept called deal flow, how can people know that you're acquiring a business? And there's two routes that are commonly used. One is direct mail or LinkedIn. Everybody in this room, I'm going to guess, in the last, maybe not 30 days, but certainly in the last 90 days, if you're on LinkedIn, you've either got a message on LinkedIn or you've got a letter in the post that says, "Hi, Emma, you know, we like your XYZ company XYZ Limited, and we're looking to acquire companies in your sector. If you'd be interested in a conversation, let us know." And what that is, who in this room has had a letter like that through about your company, like acquiring companies, or you get the LinkedIn invitations? What's happening is professional firms that are either brokers or are actually looking to buy themselves, they just look on company's house, they do some kind of financial balance sheet analysis that we're going to talk about a little bit later on, and then they just send letters out saying, yeah, we'd be interested in your company, we like the look of it, it's in the sector, and you meet our criteria for size, generally. Okay? Direct mail approach, and we'll talk more specifically about that later if you wish to do that. The second one is infinitely more successful, but more laborious, Tony, and that is good old-fashioned word of mouth. Chances are your next acquisition, Rob, is in your phone book right now. They're already in your phone book. There's somebody that you know in your profession that actually, if you could facilitate that conversation, they would sell their company to you. And in fact, in my experience, deals that are done via mutual connections are far more likely to succeed than any one that's done cold via direct mail or any kind of marketing technique, because there is inherently a great degree of trust, Lisa, that comes with it. There's a great degree of trust. Oh, I know Lisa, Lisa knows me, etc. So it's easier to work through the details when it's somebody unknown. Immediately you have this standoff. They want to buy my baby, or you're trying to buy their company, and they're acting like, oh, you want to buy my baby, and it doesn't get off the ground. So it's good old-fashioned word of mouth. So if I was going to tell you guys to do one thing only to find companies to buy, Rob, Omar, it would be get out your phone book, go down and make a hit list. You want to have an idea, Carl, for what type of companies. There might be a geographical element, Richard. There might be a size element. Okay, because you've got to remember, if you buy this company, somebody's got to run the damn thing. Right? So it's probably not the wisest thing for you to go and buy a company that's 10x your size unless you're extraordinarily well capitalized or you've got some extremely powerful friends that have run companies at that size. Okay? So you're probably looking for companies that may not be massively different in size than your own, or smaller, Rob, that are bolt-on acquisitions, so you can pull their revenue inside your stable. It would be coming up with a hit list, ranking them, and then going after them, sending out messages. Second tip, related to the first, John is, I don't know why this is the case, but when I first got into this and I went out trying to buy every business and I messaged every single person on my phone book, I was one notch above an MLM marketer, Simon, with how I did it. Went to every friend and family member who's ever had a business ever and tried to persuade them to sell to me and pestered the heck out of them. I failed miserably. Don't know why this is the case, Christian, but it's proven true to me many, many times. If you're trying to buy a business, tell everybody you're trying to sell yours. And if you're trying to sell a business, tell everybody you're looking to buy other businesses. I don't know how it's true. I've got a theory, if you'd like to hear it. My theory, Alex, is when I went round saying, oh, Grace, I want to buy a business. Lisa, I want to buy a business. Ashley, I want to buy a business. I think it naturally put people's heckles up, like a sales radar, and therefore they were wary about what to tell me, and it all became very standoffish because they didn't want to say anything. They either genuinely just didn't want to sell, or they didn't want to say anything that would diminish the value, and we never really got past go, so to speak. But when I figured this out was when I did my first big exit. When I was looking to sell my company, I went around trying, Tony, to peddle my wares and sell this company and find a buyer for it. I would find that a lot of people would say, actually, no, Dan, thank you for thinking of us, but we're actually thinking about selling ourselves. And then when I did this enough times, and I had like I had more buyers in like a 6-week period than I'd had in the previous year of trying to buy a company before I prepared to sell one. And then I had all these people saying, actually, no, we're not looking to buy because actually we're in a bit of trouble and we're thinking about selling. And then I realized I had more open conversation with Tony and people like Tony that we could then go, oh, actually, okay, well, let's discuss that. And it naturally facilitated a conversation which looked like, okay, well, actually, I'm looking for a bigger exit. So if I buy you, if you sell to me, you get to get out now, and then I get to get out with a bigger company later. So, first tip is chances are it's somebody in your phone book, Ashley, is your next acquisition. And point 2 is you're trying to create relationships. You're not trying to buy the company with that first conversation. You're literally just trying to be prepared, Alex, to have lots of cups of coffee. Lots of cups of coffee. Another favourite story that some of my private clients get to laugh at me for is I'm basically teetotal, have been since I've been about 18, 19. Basically teetotal. I've not been for the last 5 or so years, Simon, because I've figured out that a lot of cups of coffee, the conversation often flowed better in the evening after a drink or two. So if you ever see me with a drink in hand, either I've had a child be born, I've gotten married, or I'm trying to buy a company, okay? Which is quite a dicey game to play because 1 to 3 drinks I'm okay. After that, it all goes downhill. It all goes downhill rapidly. So be just looking to build the relationship, Rob. We all want to buy them tomorrow, but actually, the more you try and push it, the more they tend to run away. It's much more of it's always a very relaxed conversation. Get them to open up. You're sharing with them openly about how might that work. Then all of a sudden, you'll find that things move very quickly. That's my experience. So this is just the taster on deal flow. We'll loop back around to this later. So it's quite hard to go around the room and have an exercise. But what I'm going to do now is I'm just going to give you 5 minutes, Rob, and I just want you to come up with a list. So let's say that nobody's going to fire. There is no magic bullet to my awareness, and I've got a lot of angel investor friends, a lot of heavyweights. Ask Simon later. I don't know anybody that's got a really robust way of finding great deals. That's everybody's big concern. And I'm telling you right now, a great deal is somebody that you've got good rapport with because it'll allow for more give and take, Simon, in the negotiation. So let's pretend, Christian, that you're not going to have anything, and everything you're going to learn throughout the rest of today, you've got to apply to this handful of names you're going to come up with in the next 5 minutes. Get out your phone book, rack your brain, make a list of your competitors, make a list of your suppliers, make a list of your biggest customers, right? Because up or down the supply chain or sideways or one step sideways, complementary businesses, you already know the MD or somebody with significant control in that company. Make a little list, and then if you want bonus points after you've come up with that call, maybe even try and rank them. Who would you phone first following today if you were going to try and facilitate a deal. Any questions on this little 5-minute Kickstarter exercise, Omar?
So we're creating a list of potential purchases, but also people that can refer us, is that right?
Yes, actually, so that, thank you for the clarity. I was intending potential purchases, but I would also include on that list anybody who's well connected that might be able to introduce you to possible acquisitions is worthy putting on the list. Thank you, Omar. Any other questions? All right, 5 minutes, away we go. Come on back. Greg, Rob, and Matt, who are on the live stream, feel free to chip in with your questions or comments about deal flow. Deal flow. So comments, questions in the room first, and then we'll get Greg Elliott, Robert Jones, Matt Villingham. Feel free to post in the chat questions, comments, thoughts, shares about deal flow. What do you come up with, Emma? Oh, let me grab a boom mic.
Well, I didn't think I'd get much of a list because there's only about 4 players in our industry. So when you think about acquiring somebody, so I started to think more laterally around, okay, so who sells to our clients and who's got databases and such like. And my list just kind of expanded massively when I opened my mind to just who else is out there. And there probably are some people really struggling who do like have online directories. So what we do in person, they do online. So, and they will have, you know, thousands and thousands of people hitting their website well, not so much now because of the industry, but they'll have all that data. And even there's so many venue finding agencies that have gone under in the last, or clinging on, and they know, it's their job to know every hotel in the UK that that's who we sell to.
That's so, great, great lateral thinking. I like that a lot. Good. And just think about this. In the context of in this room, you might not know anybody, but how many of the people in this room know people in your sector? You might know anybody, but in this room there's, I don't know, representative, let me do a rough estimate. There are, I don't know, several hundred employees, right, that we employ in this room. So hundreds of employees that we employ in this room. Do your employees know people, etc.? Yep, it can be a high leverage activity. Good, thanks Emma. Somebody else? Come on, come on. Go on, Josh.
A good person I thought of would be there's a guy that I know who does like pensions and financial planning and stuff like that. So if he's working with self-employed people and business owners who are looking to retire or sell or whatever, then he's got a pool of people who will want to retire or get out at some point. So maybe that might be a good person to keep.
So think about this. So this is a great one that Josh has come up with. Think about this. Who, if somebody's trying to sell their business, who do they tell? They tell they might tell their spouse, and then they'll tell their accountant, and maybe their lawyer. Right? And there's a reason. So the mastermind members in the room have heard me say this many times. What type of business have I been trying to buy for years? Accounting firm. Is it because I want to own an accountancy firm? No offense to accountants, and I've got some as friends, so I'd say this to their face. They're not exactly the life and soul of the party, generally, as a breed, but it's because it would get me a lot more deal flow. And then that's why also earlier this year, I invested into, and so took a stake in a bookkeeping company, because I've struggled to get to terms with an accountant, even though I've had a reasonable amount of deal flow. I haven't managed to land that fish yet, but that's why. But certainly you can get there by just having rapport with those people, okay? And the same true for lawyers. Same's true for insolvency practitioners. Okay, we're going to talk about types of company purchase in a moment. But here's a better question to consider. Let me just check. Okay, Greg, Matt, Rob, don't be shy. You're going to have to post. You posted earlier in the chat. Post again, otherwise I'll start picking on you. What questions do you have or comments about deal flow? So here's a question for the room. Think. Who is the ideal target? Tell me, who is the ideal target? Somebody's had enough. Good. What else? Good. A business that is complementary or perhaps is a supplier, because that will minimize your costs. Good. Somebody who's retiring. Good. So we're going to talk later about distressed businesses, but I'd put it to you, I'm not averse to buying distressed businesses if you can de-risk it and buy the good bits and mitigate the risk, but I'm far more in favour of having a distressed seller. Okay, distressed seller, but not a distressed business, right? As in, think about this in property terms, right? You all, any other than Richard, who in here dabbles a little bit in property investment or owns other properties? Buy-to-let, many in the room? Oh, only a couple of you, okay. So you've seen the ads in the newspaper though. We'll buy homes for cash, homes bought quickly. What they're looking for, ideally, are properties where they can clearly value the property as being worth X pounds, £100,000, but the seller is distressed and needs to sell now. So it's going to get repossessed, which means it'll get sold at auction dirt cheap, and then the mortgage company will pursue the person and push them into bankruptcy if necessary for the difference. Some investors might look to go and say, okay, you owe $75,000 on the mortgage, and the house is worth £100,000. We'll buy the house for $75,000 or maybe $80,000, right? So they buy the asset cheap, and the asset's in good condition, right? But it's a distressed seller. So it's divorce, moving away, those kind of things. Or as Steve said earlier, somebody who's had enough. Somebody who's just, they want to be done with the stress, okay? Somebody that's trying to haggle over their every last pound, shilling and pence on the negotiation table. Said a different way, Omar, more succinctly, the winning is done when you buy. So it's with the purchase, Carl, is with the purchase that you make money, right? And that's a combination of actually the financial element, which we'll talk about in more depth, but it's also about the de-risking it so it doesn't bite you in the backside later. Okay? So they're the considerations on deal flow for now. You want to have volume. You want to always be having conversations about acquiring businesses constantly. It's the only way that I know of, Christian, that you can double your sales in an afternoon. Right? Because a lot of these times, especially when people are distressed, you might have the conversation now, but it's 2 years from now, Christian, when a competitor calls you up and says, hey, when you spoke to me, but they 2 years down the line, they've gotten in trouble or they've decided they've had enough, and they think of you because you were the only person that they ever had a conversation with about, would they consider selling their business one day? Then all of a sudden, I've seen companies being bought and sold in a week. My personal quickest is about a month from initial conversation to everything being done, money being paid, etc. But I've got friends that have done it in a week. So it's one of those whereby you need to be in the minds of the people, Rob, so that when they decide that they've had enough, that they pick up the phone to you. Okay? That's all we're going to touch on deal flow for now, unless there's any final burning questions, but we will loop back round this afternoon after we've got through the groundworks. Okay, nothing on here. All right. Yes, go ahead, John.
Is there any difference in saying like you're looking to invest in companies rather than buy so that people are more attracted to them?
Good question. So the question was for the mic, is there any difference in saying that you're looking to invest in companies rather than you're looking to buy them? I'm going to say, so I'll answer the question now, but we'll probably get into it more as it comes to deal structure, okay? Because language is important, Alex. So when somebody reads invest in, so my experience, John, is it attracts a different type of person. If you're wanting to buy a company outright, the person's more likely to be attracted by you saying, I'm looking to buy businesses in this sector. If, however, you use the term invest, you're probably more likely to attract to somebody who's keen and ambitious to grow, and they think that you're going to put up the money. Now, if you are going to put up the money, you can talk about ways, Tony, that you can de-risk that. You can de-risk, Rob, the putting up of the money. Okay, how do you do it so that you're preferential, etc., and you're protected first, Omar? Great. But often with those people, With the former person, it's all about price. You want to buy their company, they want to sell, they want to get the maximum price. That's where the bottleneck is, that you're going to get a variety of ways to get around later. With the person that's looking for investment, you'll find that they want to give you, it'll still be about price to a degree, but it's more about control. They'll typically go, yeah, we'll have an investor. That involves you giving me all your money, and I'll run the business how I damn well please, and I'll give you 2%. Right? This kind of stuff happens all the time. So it can be useful, John, and that's a bit of a shitty answer, but it's the best that I've got for now. It depends what your long-term strategic intent is. For those people that are looking to roll up and put 10 gyms together, or not 10, but 20, 50, 100, and float on AIM, right, they'll often use the investing term, because they'll go and rally everybody and, hey, we'll invest in your business. You come into our group and you get a stake in our much bigger group, and then we're all going to float on the stock market and we're all going to get rich. Right, that's more the tone, if that's your strategic intent. Okay? But I'll give more examples when we get into the next stage. So, next stage, step 2 of 3. But this is very broadly encapsulating a lot of things. De-risk. So let's just say for a second, let's accelerate to the end, Alex, Grace, and let's say you've now got 10 competitors, suppliers, etc., or customers that you sell to that are willing to sell you their business. Okay, and it'll come under this step, but let's say we're even got to the point where we're talking about numbers. What does that mean in financial terms? Okay, now how do we de-risk the transaction? How do we de-risk it financially? How do we de-risk it legally? But also, how part of the de-risking could be maximizing the upside. How do we minimize the downside, and how do we maximize the upside? Because the quicker the thing makes money relative to our capital invested, actually, the quicker we've got our money back, the quicker we are financially, at least, de-risked, even though we could still be legally and emotionally at great risk. Okay? So, as a primer for this, I've got another little video for you. It says at the end of the video, it's some business school or other. These guys, they're a little bit, bless them, I suspect they've been educated at private school, but they're actually really smart, and their content's really good, and it's a good primer for this section. So, this is the next video.
Hello, I'm Andrew Campbell, and this is David Smith, and we run the best mergers and acquisitions course in Europe. And in the next few minutes, we're going to give you 5 tips that will make you a lot of money in acquisition deals. So listen up. Tip number 1. Tip number 1 is about incremental value. Every deal needs to generate some extra dollars, some extra pounds, some extra euros from the combination of the two organizations. And I'm not talking here about 5% extra or 10% extra. A minimum of 50% extra. In fact, I don't really get excited until I can see 100% extra as a result of the combination. 200%, 300%, and you have really exciting deals. David, what do you think?
Andrew, I couldn't agree more. I think I hear so often companies doing things for strategic reasons or to get into a new market, and they just don't seem to have remembered that the whole purpose of doing a deal is actually to create incremental value. So there is no increment, so the deals don't succeed.
Right on the button. Now, tip number 2, David.
Tip number 2. Tip number 2 is don't listen to your advisors, or if you do so, listen very selectively. The reason I say that is because most companies negotiate a fee with their advisors, which is contingent on the deal going ahead. So guess what? You get advisors who are motivated to do the deal, even if things begin to look a little bit sticky. So consequently, you have to be aware that the advisors are going to incline you to want to do the deal, even if in their heart of hearts they feel it's maybe not the right thing. So be very careful when you listen up to what they say.
And this is something that Warren Buffett, world's richest man, has spotted. He came up with the idea that every large deal should have a consultant working on the deal who's only gets paid or only gets a bonus if the deal doesn't go through. So in the deal team, you've then got the advisors who are all desperate to make the deal happen, and you've got somebody there who gets paid if it doesn't happen.
fascinating way, I must say. But Andrew, what is tip number 3?
Tip number three is about revenue synergies. The data is absolutely convincing. Deals that are driven primarily by revenue synergies, that's synergies that give extra sales as a result of the combination, extra sales from cross-selling, extra sales from having a stronger position in the marketplace, extra sales from better utilization of technology. Deals that have extra sales perform better than deals that are driven primarily by cost savings. So look out for the deals where the prime driver is revenue synergies. Tip number 3, David.
Tip number 4 even.
Oh, tip number 4. Okay, go for it.
Tip number 4 is create an implementation plan and create it early. And make sure you know who is going to be involved in the implementation process. Because what you want to do is make sure that those people are also involved in the acquisition itself. The reason being, you want their fingerprints all over the acquisition plan so that they will then be responsible for delivering on the deal later. What you're trying to build up here is commitment, and commitment comes when you buy into the process. Buying in and then being responsible for delivery is critical, and that's why I say create an implementation plan and create it early, and then make sure you get delivery on it. Tip number 5, Andrew.
Tip number 5. Now, tip number 5 is another tip I've stolen from Warren Buffett. Margin for error. One of his great policies in making investment decisions is there should be a margin for error, that if things don't turn out as the paperwork suggests that they are, the deal still looks good. And this is true for acquisitions just as it is for investing in stocks and shares. If you find that you're scraping the barrel to generate enough synergies to justify the deal price, don't do it. Go back to bed. If you find that you haven't got the management that you would ideally like to have to lead the implementation process, cut off negotiations. If you're not convinced that the other side are being completely straightforward with you and the deal's a tight one, don't do the deal. Unless you are comfortable that the deal that you're doing is going to create lots of value and has room for it to be worse than you thought it was going to be, you are chasing the wrong sort of deals. Most deals look much worse 3 years after than the day you close negotiations.
Andrew, a great tip. And altogether 5 great tips. But guess what? On our Making Successful Acquisitions program at the Ashridge Business School, we have got a whole lot more tips, which we'd love to tell you. So what we'd like you to do is sign up for the program, come and hear us.
Good. So, I thought that was a pretty good summary or primer. We're going to actually take a coffee break shortly, but before I do that, any comments or questions that video kind of kicked up? Go ahead, Rob.
I've often looked at it and thought, I should look at buying other loftboarding companies, and that presents a challenge because most of them are one-man bands and there's nothing to buy. And it's maybe start thinking, I should be looking at manufacturers of loft ladders and manufacturers of loft hatches perhaps, and people who supply us, because that's where the synergies come in, and that way I'm making money off my competitors when they buy the products as well.
Yes, 100%. Well, for context, do you mind, I won't be specific about it, but are you okay if I mention about the acquisition last year? Yeah, yes, so Rob bought, I think, and correct me if I misspeak, Rob, but I think this idea probably was born out of, or I remember it coming up in a private mastermind meeting at some stage. I don't know if you brought it to the table already or whether it was brought up, but it became apparent that the company that Rob uses a proprietary system for loftboarding. It's not just putting planks of wood down, it's like an elevated floor system. And the company that Rob bought all this from, he was their biggest customer by far, and that was a risk for the business. So Rob, over a period of time, negotiated and bought a stake in that business. in part to de-risk himself, but then in theory at least, and again I won't put Rob on the spot, but I remember the conversations about, well actually, can that lower your cost? Because if you buy a supplier, but then you're supplying yourself and you supply yourself cheaper or at cost, if you're able to do that, you may not be able to if you've got other shareholders in the company, but if you're able to do that, you thus increase your profit. So that's an example of a cost saving or a synergy, but also it would give Rob insight into, okay, who are the other customers of this supplier and how big are they and how are they doing, and even, Tony, are they stressed? Are they struggling to make payments? Are they, right, because you know from the size of their order, Christian, how big they probably are and how, and their tendency to pay on time or not therein might give us a suggestion for how their cash flow works. So for a variety of reasons, is that a pretty good summary as to why you did that acquisition, Rob?
It was about de-risking as well, because if they decided not to supply us, we had a big problem.
Yeah, correct. In fact, that was probably the primary, wasn't it? Because Rob's business was growing quickly, making money, and if he fell out with the supplier and they were the sole supplier, all of a sudden he'd be in deep trouble. So we discussed other suppliers, but Rob was happy that this one was the best. We discussed Rob investing in and making his own system and patenting it, but couldn't breach their patent. And in the end, the conclusion was reached that actually it's cheaper and more cost effective and faster, Simon, to actually make buy shares in this company. Good? Thanks, Rob. Anybody else? Comments, thoughts, questions? There's only one thing in that video which I strongly, or my experience is very different to theirs, and it might be to do with deal size. So this might be a question for Simon later. So I think it was their tip number 2, or it might be number 3, when they were talking about listen selectively to your advisors. In my experience, while when I listen to the lawyers and accountants, they're more often than not trying to talk me out of it. And actually, I probably want to listen to them more carefully. They were talking about it, and I believe this is just the case when it gets bigger in size, that all of a sudden the lawyers and accountants are getting more fees because they get fees the more due diligence is done, but that's probably a fee you're going to incur either way. So my experience actually is a lawyer will want to do more due diligence than is necessary, and then they rack up more fees, right? But oftentimes with these bigger acquisitions, the advisors have paid fees if the deal successfully closes, and therefore they were suggesting they'll blind you to what's actually going on, and you should think of more reasons to walk away. My experience is actually the opposite. While you want to listen to your legal advisors, etc., sometimes they'll talk me to the ends of the earth as why not to do the deal. So a lawyer, I remember a lawyer in one of my last transactions, 1 or 2 companies ago, it was at the closing stage and I was selling, and at the end the lawyer wanted me to spend about 2, 3, 4 grand to cover off one point in the contract, which at maximum, worst case scenario, the risk I was exposed to was about 2 grand. And when I kind of I didn't pull that out of him, when I kind of just deduced that myself, I went, and it's the lawyer I still use now, and I think he's great. I went, Michael, what are you doing to me? This is ridiculous. And he went, well, my job is to point out all the risks, and you are exposed here. And I'm like, yeah, but as soon as I factor in your time and how long it's going to take to do it, and the fact that the deal might not close now while we fanny around over this clause, it's not worth it, right? Now, just be clear, the less experienced you are, the more inclined I am to say to listen to your advisors, but that often you do have to get to a point when you've got enough experience to go, and I remember saying to him, it's going to be fine. And if it does fall down, I mean, that was only a small deal, it was like less than 100 grand, but I said, if I lose this 2.5 grand, I can live with it. Let's not lose the deal, right? But that's just one thing I wanted to throw out there, because it was the opposite of what those clearly very experienced people were saying on screen, and I think that probably relates to deal size. I think you need to have a good team around you. So, any final comments before we take a coffee break? All right.